An economic recession would definitely hurt housing demand and put downward pressure on home prices. But would it be enough to crash the U.S. housing market at the national level? In today's video, we're going to look at what could happen to home prices if a recession did occur, and what it would take to bring down a U.S. housing market that has yet to decline despite high mortgage rates and record levels of unaffordability. Let's get into it. The U.S. housing market has defied expectations of a collapse in the face of the record high prices and the highest mortgage rates in decades. According to the latest data from Redfin, a national real estate brokerage, the U.S. median home price came in at $409,000 in September on a seasonally adjusted basis, which is up 2% from the low point in March. This apparent strength is even more surprising given that mortgage rates continue to head higher and came in at 7.76% on November 2nd, according to Freddie Mac. The tight supply in the U.S. market overall has been the primary reason prices remain high. I want to emphasize that I'm just looking at national level statistics in this video. Different metropolitan areas are going to have drastically different price performance potentially. I highlighted this in a recent video where I look at the top 10 metros for best and worst price performance. There is a lot of variation. So keep in mind here that I'm looking at the national average, which is going to be quite different than specific regional markets. In some of my other recent videos, I've looked at how much the median home price in the U.S. could decline if we saw a sharp increase in supply from pent-up supply or unprofitable short-term rentals hitting the market. At worst, I found that prices could decline by up to 6.8% if we saw that supply hitting the market and everything else staying the same. The reason I found there wouldn't be a bigger price decline is because there is a lot of pent-up demand as well that could absorb higher inventory. Sales volume is at the lowest in years, and there are a lot of buyers out there that would pounce on new listings even if they were at only slightly reduced prices. But what if we saw a collapse in housing demand? An economic recession could be a cause for this, and there are a lot of people that are expecting a recession in the next 6 to 12 months. That's what I'm going to test in today's video. I'm going to give you the results up front, so if you want a better idea of how I got there, stick around to the end of the video. Okay, so I looked at two scenarios. One, where there would be a recession over the next 12 months of average intensity, and the second, where there would be a surge in inventory from pent-up supply and unprofitable short-term rentals hitting the market, in addition to a recession of average intensity. In the first scenario, I found that a recession of average intensity and duration would be associated with an 11% decline in the U.S. median home price. A big drop, but still far off from a full-blown housing crash of 30% or more. Now, make no mistake about it, 11% is a pretty big correction for home prices. Why isn't it a bigger decline? Well, even with an average increase in supply associated with a recession, we are still at very low levels of inventory, which would prevent an even larger decline. That brings us to the next scenario. What if we had a surge in inventory from pent-up supply and unprofitable short-term rentals hitting the market in addition to a recession of average intensity and duration? In this scenario, I found that the U.S. median home price could fall by 25%. This isn't as big of a price decline as what we saw in the last housing bubble, but you can't look at this graph and tell me with a straight face that this doesn't look like a full crash in home prices. The reason we see a potential housing crash in this scenario is that it is a perfect storm of factors. Not only do we have a collapse in housing demand because of job losses and income declines associated with recession, but there is also the surge in supply from pent-up inventory and unprofitable short-term rentals hitting the market. When you get a big drop in demand and a big increase in supply, basic economics tells you you're going to get a big drop in prices. Stick around if you want to know more about how I got these numbers, but if you like seeing content like this, make sure you're subscribed and hit that notification bell down below. so you know right away when my next video like this or on other topics comes out. On this channel, I focus on forward-looking real estate analysis for the U.S. and regional markets. I'm a licensed real estate agent in the state of California, as well as a professional economist. So I can bring you original research like what you're seeing in today's video. If you found this video useful, go ahead and hit that like button to support the channel, help it grow. Now, for how I got the numbers that I presented, I used an econometric time series model similar to what I used in my other supply surge videos. This model includes both housing market and macroeconomic variables. This model estimates how these different variables are correlated with the U.S. median home price. By making changes to the variables in the model, I can see what kind of change would be likely for the U.S. median home price. To simulate a recession in the model, I calculated what the average change was in each variable in past recessions. For example, non-farm payroll employment is one of the variables in the model. And looking back at recessions over the last 80 years, I found that non-farm employment decreased by an average of 3.5% over a 12-month period. I did this research for each variable in the model to construct a future scenario of what a recession of average intensity would look like. Then I run those numbers through the model to get the associated price change. This is how I found that home prices could decline by an average of 11% during an average recession, and could fall by 25% if there was an average recession in addition to a surge in supply. If you've made it this far in the video, I hope you will consider subscribing if you haven't already. Because I'm an economist with real industry experience in this type of analysis, I can bring you original research like this. In future videos, I'm going to be tracking what is happening with supply and demand to see if we are heading in the direction of any of these scenarios. That's it for today. Don't forget to hit that like button on the way out. Thanks for stopping by. I'll see you in the next video.